Welcome to the Well Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Masri. Today I interviewed Cory Sperle, who is a successful real estate entrepreneur and investment coach out of Kelowna, BC. He's been investing in Canadian real estate for 22 years, and he's an expert on multifamily investing specifically. He focuses on acquiring projects with significant upside potential. He's actually bought 10 apartment buildings in the last decade with a value exceeding $25 million. So on this episode, we talked about why Cory lives in British Columbia but invests in Edmonton and Saskatchewan as well. Recent apartment building project case studies, refinancing multifamily buildings and why you need to be cautious in today's environment, having substantial reserve funds, managing partner expectations, and also we talk a little bit about the 6 pillars of multifamily investing course that he's offering. So I hope you guys enjoy the episode. I just want to remind you to leave us a review on the Apple Podcast platform. So if you have an iPhone or a Mac, you can go on the Apple Podcasts app, scroll towards the reviews page, leave us a 5-star. That would be greatly appreciated. And if you want to talk about some multifamily opportunities, we've got some apartment buildings as always. So more than happy to discuss with you. You can just go to Instagram, WellOffX, reach out to me there. Or even if you just want to chat, you want to discuss something you're going through, you want any sort of support or help on a project that you're working on, I'm more than happy to chat with you. There you go. Enjoy the episode. All right, I'm here with Cory, who's joining us from Kelowna, BC today. Cory, thank you for taking the time out of your day to do the podcast.
Well, thanks for inviting me, George. I'm really excited to be here today.
Great. So let's start off by talking about your childhood. Did you grow up in Kelowna, or is it? I think you had mentioned before we started that you moved to BC a couple years ago. So where did you grow up then?
Yeah, I definitely did not grow up in Kelowna. I think my life would have turned out differently if I had. Just kidding. No, I'm actually small town, prairies, pretty much as small town as you can get. I grew up in Unity, Saskatchewan, kind of near the Alberta border. Very rural community, farming community, about 2,500 people. And, that's basically where I grew up. That's where my life began. So.
Wow. Yeah, I'm always surprised when I hear someone say they grew up in a town with 2,500 people where most people are farmers, a lot of hockey, and then you end up moving to Kelowna and buying a bunch of real estate and investing. Like it's a pretty cool story.
Yeah. There's definitely been a lot of twists and turns in the story, but yeah, I think growing up in a small town is unique to a lot of people. And those people that are listening that have grown up there, they know what I'm talking about. So
Yeah. So tell us about that journey. How did you go from a little town of 2,500 people, Unity, Saskatchewan, to basically Vancouver, or not Vancouver, sorry, Kelowna, BC, and your journey of becoming an investor?
yeah, from back then to over 30 million in multifamily assets, it's quite a story. Now I did it very slowly. I've been investing for a long time. Okay, 23 years, very much baby steps. I went to high school. I went to tech college in Moose Jaw, which is like the technical school in Saskatchewan. So I learned electronics and instrumentation, and that was basically my day job for the next 25 years. So real estate for me was a lot of a side hustle, right? Because I would work shift work. I would sort of be interested in investing, but I was always kind of scared to take a step. It wasn't really until I was around 30 I bought my first house in Saskatoon. So that's where I moved. That was the year 2000. That was basically when I started. And, I read the dreaded Purple book, Rich Dad, Poor Dad, like a lot of people did. Kind of an eye-opener. And I started to invest. I started to work overseas, so I had a lot of time on my hands. I worked a month on, month off. So I started to invest passively in multifamily. And I got onto a few guys who were doing it already. And the market in Alberta at the time, the early to mid 2000s, was smoking hot. I mean, you couldn't lose money on real estate. So that basically got me hooked. And around 2008, I bought my first apartment building. And now this year, I'm actually on my 11th building. So I lived predominantly in Edmonton from 2005 to 2015. And then I decided to move out to Kelowna basically for lifestyle reasons. But I'm kind of an interprovincial investor, I guess, because all my properties are in other provinces.
Yeah. Again, before we started, we were kind of talking about how you've lived in BC for 8 years, but you haven't bought any real estate in BC. Can you tell us a little bit about that?
Yeah, I bought basically a primary residence, right? When I moved here in 2014, the markets were backwards from what they are now. I mean, Edmonton was hot. It was the height of the oil boom. Properties were skyrocketing, and property in Kelowna was cheap. So I ended up buying something for half the price here, just a primary residence. Today it's completely the other way around, right? It's it's still low in Alberta, and it's really high in Kelowna where I'm
Mhm.
at now. But yeah, I just bought a couple of houses here. I looked at the rental markets. I'm a very big strategic investor in adding value, repositioning properties, getting increasing cash flow. And I found that you just couldn't do that in BC for a couple of reasons. Like it was the very high price points. I mean, if you just mentioned if you were in Vancouver, if you're looking at multifamily out there, you're probably paying 400,000 a door.
Mhm.
In Edmonton, I'm paying 100,000 a door, right? In
Yeah.
Ontario,
Yeah.
where you are, depending on where you are, I mean, the smaller communities, and you're still at like 200 ish.
Yeah.
Um,
Yeah. That's true.
so yeah, so those are the reasons, and the second reason was the rent controls. The tenants had way too much power here. I had friends here that owned rentals, and I just heard horror stories of grow ops and meth labs and not being able to evict tenants. And I just decided it was best to stick to what I know, and that's why I
Mhm.
remained on the prairies.
Okay. I'm not an expert by any means on the Alberta market, but it seems like based on some of the people that I've spoken to that invest there's been some turbulence over the years in terms of real estate prices. A lot of it is kind of connected to oil and how that's doing and whatnot. Does that worry you at all as an investor if you're primarily investing in that market?
Yeah, I love that question because a year ago, before I really started to kind of branch out and talk to other
Mhm.
investors in Ontario, Alberta was the center of my universe. It was the least risky place you could invest. I'm like, people would say like, cycles, boom and bust. Like, what are you talking about? But I hadn't really been through any. And it was right around that time of 2015 when the markets were basically down for 8 years straight. I mean, we had
Mhm.
declining to flat rents. I had 20% vacancy in Saskatoon, and that didn't happen in Ontario. That didn't happen in BC.
Yeah.
And after I started talking to some people, I realized, yeah, maybe in Ontario, investment would have been a little bit more stable,
Mhm.
at least in the long term. But I like the Alberta markets because I can buy at a cheap enough price point. I know what I'm doing now. I mean, I took my lumps. I lost money on my earlier deals with my own money before I got involved in joint ventures. So I
Mhm.
learned how to really value properties, how to analyze them, and not overpay, not buy into riskier markets. And I was able to sail through the downturn, relatively unscathed. I mean, I had healthy reserve funds. And now I'm in such a powerful position of reserve funds and all these assets and new investors coming on, and we're going into an up market. So we're very well
Mhm.
positioned. So yes, it should have worried me when it didn't, but now it doesn't so much because my portfolio has been tested, like stress tested to that level, if that
Sure,
makes sense.
sure. On a recent podcast, I had interviewed some guys that have a lot of like market data and whatnot, and they were saying that the Ontario markets are down, so we're kind of in a recession at this point. But Alberta and a lot of other provinces are doing really well. Why do you think that is? I know you're not necessarily like an economist or somebody who studies all of Canada, but just in your opinion, why do you think that Alberta's doing well whereas Ontario's in a recession?
Well, I think there's kind of two parts to that question. Like, so first of all, there's different types of properties. Like, if you talk to Quentin D'Souza, he would say like multifamily in Ontario is as strong as it ever is if you can find a
Yeah.
deal. But on the residential space and your basic investment, like if you're buying like a duplex or a single family, for sure. I mean, I've heard stories of like maybe Peterborough and areas like that where real estate's down 30% year over year, right? In Alberta, it's maybe down 2 or 3%. And
Hmm.
I think a large part of that is because we didn't have the massive bump during COVID that everyone else did. Like where I lived in Kelowna here, stuff went up like 60%. Like it was
Yeah.
crazy. And for no reason,
Yeah.
right?
Yeah.
And in Ontario too, I mean, people's incomes didn't suddenly go up 60%, but that was the nature of it, just kind of took a speculative hold.
Hmm.
And New Brunswick is another prime example. Like areas like Moncton really hit the speculative button too.
Oh yeah.
And now
Yeah.
they're paying the price, by coming back down to earth. And I think Ontario is a lot like that too. And I think for a lot of people in Ontario, they maybe have short memories or they didn't realize that the last recession basically for real estate was 1989 to 1996, right? And it
Hmm.
was long and it was ugly. It didn't
Hmm.
bounce back right away. So I think that's part of it. Part of the reason is just cost of living. I mean, it's gotten so expensive to live in Ontario to rent. I mean, your two bedroom rents, one bedroom rents are well over $2,000 now. I mean, you can move to Edmonton or Calgary for $1,000, right? It's price points. The third part of that is we have a lot of immigration is back on now after the pandemic, so we're going to have 500,000 plus new Canadians. They usually predominantly land in Quebec and Ontario, but after they look around, they realize they can make more money. There's higher wages on the prairies, and the cost of living is a lot cheaper.
Yeah.
And it's
Yeah.
more business friendly, lower taxes. So, most immigrants are natural entrepreneurs. They want to come and start businesses. So I've noticed that really very high in Saskatoon because I have apartment buildings there as well. A very high Ukrainian base. And obviously, with the war going on, we have a lot of people coming in. And after 5 years of basically ghosts and crickets, in these markets, I mean, you just have to look at Calgary, for example. 60,000 people moved in there in the summer of 22 alone. And I look at the stats where they're coming from. It's mostly from Ontario, but it's also from
Yeah.
BC.
Yeah.
So that tells me people are coming back for work. They're coming back for the jobs. They're coming for the opportunity.
Yeah, that was one of the things also on the previous podcast that they were saying Ontario, they're generally projecting that most immigrants will come to Ontario, but if we are going to experience a recession, whereas somewhere like Alberta is doing pretty well economically, then people may say, well, forget Ontario, let's go straight to Alberta. Like you said, you can get the same kind of job, same kind of wage. It's a lot cheaper out there. So maybe you guys are going to be stealing some of our immigrants.
Well, there's a lot of FOMO too, because imagine if you're living with your parents and you've been saving up for a down payment on a house, and now it's always just been out of reach, right? And now it's like, man, it's still $1 million to buy a house in Ontario.
Hmm.
Hey, I can go to Edmonton or Calgary and I can buy something for 300,000. Next year it might be 500,000, 600,000. This could be my last chance to own a house in this country.
Yeah.
And I'm kind of thinking that too, man. I got to buy some singles in Calgary. And who knows where it's going to happen? I mean, if you tell someone in in Edmonton that your house is going to double in 2 years, you kind of get strange looks. Even though that actually happened in 2006 to 2007, right? I bought a
Yeah.
house for less than 200, and it went to 400 a year and a half later. So we do have
Yeah.
incredibly crazy spikes like that on the prairies too. But
Yeah.
since
Yeah.
then, we basically still haven't caught up to 2007. I mean, I talked to Russell Westcott. He just sold a house, and he still wasn't up to 2007 levels today.
Wow.
And that's a
Wow,
lot
that's
of years
crazy.
ago.
I know, right? Like that's kind of scary, isn't it? Just to think that, but it's something that's kind of unimaginable for someone like me who grew up in the '90s. So I was too young to remember a recession.
Yeah.
Um, I never really thought as early as I started getting involved in real estate, which was in 2013. I got licensed as a realtor. I never really thought that we would experience a 30% drop in prices. It always seemed impossible to
A
me.
year ago for sure, right? Because we were at the
Yeah.
peak of the market exactly 12 months ago. I mean, if I would have told you stuff's going to tank, you probably would have got some strange looks, right?
Yeah, yeah. So it's really interesting to see it happen, and I think it's really good. It's good to see that this happen now, and a lot of people are going to come out better, and then the people that were investing speculatively are probably going to get hurt by this. But that happens cyclically, right? Um,
Yeah.
so let's talk. Let's dive into a little bit of your portfolio. We touched on some of the areas that you're investing in. So you've got. I just saw on your website you've got a couple projects. You've got Rayleigh Square, Church Road, Mansard Terrace, and the Marston Apartments. Those are kind of on the front page of your website.
Mm-hmm.
Tell us a little bit about these projects and how you're raising capital for this and that kind of stuff.
Yeah, so I bought my first two multis. If you scroll down on the site, Poplar Grove was my first building. It was a 12-suiter, complete piece of crap, 29 a door. And I was living in
Wow.
Edmonton at the time, trying to self-manage this thing and do a complete burr while I had a full-time job and a brand new baby. Yeah, let me tell you, that was not a smart investment decision. So since
Yeah.
then, I focus on niche. I find one area, and then I drop assets in there to make my to make me basically worth my property manager's time, right? Instead of having assets scattered all over the country. So a few of them you mentioned. So like for example, Chabon Place, Mansard Terrace, Marston Apartments. Those are all in Saskatoon. So I have
Hmm.
one property manager managing those. And I started in Edmonton, but I branched off into Saskatoon, creating a secondary niche. And I had headaches around that, even though I was already a sophisticated investor. But it takes time to set up your team, right? And get your portfolio optimized in a different location. Like I
Yeah.
don't know how people do it all over the country if they have projects here and there. But so Raleigh Square was a burr we did in Red Deer. That was another one. I negotiated that one for a year actually. The deal was the building was it was 48 suites, 224s. It was like completely run down, had foundation issues. I paid like 62 a door for it. We ended
Hmm.
up doing a refinance, which is like just about 3 million. We got a 90% vendor take loan, so I only put 300,000 down to buy the place, and then we refinanced it 8 months later for almost 5.4 million,
Mm.
so up to 129. So that was probably my most successful burr that I did.
Yeah.
And you mentioned church. That was kind of a smaller one we did in Spruce Grove. Spruce Grove is one of the satellite communities around Edmonton. Great market. I really love those markets like Fort Saskatchewan, Spruce Grove, Leduc, the surrounding areas. I'm not a fan of the inner city in Edmonton. I find it's a little bit too rough. A
Hmm.
lot of transition, a lot of tenant turnover. But Church and then Adams was the latest one we just did a burr. We successfully repatriated all of our equity in that one, even though the interest rates were rising very rapidly at the time. And that was the other thing we haven't really talked about, but that's also really caught investors off guard in the last year,
Yeah.
especially in the multifamily space.
Yeah.
They
Yeah.
paid a lot of money for their apartments, and with the single family, it's okay, right? They give you the renewal notice and you sign it, and away you go.
Hmm.
With a multi, they want to see your rent roll, your income statements, and your net worth. And if it doesn't line up, they ask you for equity back at
Hmm.
refinance. So this has happened to some people that I've known. So
Wow.
that kind of gives you a bit of a test drive spin of my portfolio to date.
Oh, for sure. Yeah, that I never even really thought of that, but because I guess we haven't really seen it. Renewals on these multis, you're absolutely
Yeah.
right. Maybe that's um, because generally, well, first of all, I just want to clarify to anyone listening, you've heard the term BRRRR a couple times. So that's the buy, renovate, rent, refinance, just in case anyone doesn't know what it is, although I'm pretty sure everyone does. Um, but yeah, with commercial financing, you're generally doing a 1 year term, and then there's like an annual review. Which happens where you're going to have to send them an update of all your rents and expenses and all that, and based on that, they will decide if they're going to renew the financing or if any adjustments need to be made. So what are you seeing now with investors that own these with some of these buildings? Like if they bought it, say a year ago or a year and a half ago at the height of the market, and rates are now double or triple what they were back then. What kind of trouble are you seeing, or it's not really a factor because people are well prepared?
No, it's I mean, over leverage is a killer, right? It's one of the killers with multifamily, and I'll segue into another aspect of that in a second. But I can tell you, even in my own example, I went to renew a very powerful asset. I have a mixed commercial. It's Beaumont. It's 14 townhouses and 8 commercial bays. I mean, the building it generates like 30,000 cash flow every month,
Hmm.
and the bank just decided they weren't going to renew. So I was scrambling to try to find a refinance, and because the rates are so high now, they scaled the loan back probably close to $1 million from what I thought I was going to get.
Right.
But thankfully, I still had enough equity that I was able to pay out the old mortgage.
Hmm.
So you really have to be careful, cautious with leverage these days, and people are really jumping on board for the CMHC booby trap, that I call MLI Select, where you can
Hmm.
borrow up to 95% loan to value on a 50-year amortization. So, I mean, it's great if you want to, buy a building, fix it up, recover all your cash. Then technically, everything you make beyond that is infinite rate of return. If you're thinking of it as ROI, right,
Yeah.
return on
Yeah.
investment. The only hitch with that is in 5 years you've paid off no principal. If there's any kind of a glitch 5 years from now, your rents are a little bit lower or your rates are higher, you have to pay the bank back equity.
Hmm.
And I mean, it's no secret. I mean, Chris Davies, well-known investor and realtor in Edmonton, he talks about that. That happened to him. He had to pay down $200,000 on one of his multifamily assets when it came time to renewal.
Hmm.
So, I mean, it can happen to everybody. It could have happened to me actually on the prairies. when I had those markets where rents were really down. But thankfully, my renewals didn't come up at that time. Now,
Hmm.
there's ways around it, right? You can ask for a 1 year extension, you can go interest only. But I'm hearing more and more stories of people getting caught, and they're getting caught in their burrs. Which, to clarify, I never ever called it burr. For me, it was always value add. That's a new term I've actually learned in the last year.
Yeah.
But people's burrs are getting called back because they're doing that. They're doing the short term, very expensive financing, and then they're not able to get the equity back to pay out the burr,
Yeah.
and then
Yeah.
you're really in trouble, right?
Right. Yeah. So just to kind of give an example in case somebody's having a hard time following, let's just say you bought a building a year and a half ago, just to keep it really simple, for
Yeah,
$1 million. And in the last year and a half, rents came down a little bit, and we know that these buildings are valued based on the net operating income and the cap rate. So if your rents come down, that means technically the value of your building comes down, and now you're due for a renewal, and the rates have gone up. So now all of a sudden your building's worth let's say 100 grand less than before. Well, the bank's not going to renew it at the original terms, so you're going to have to cough up 100 grand just to continue, just to keep the mortgage on this place. So
yeah,
that's pretty much the thing, right?
yeah. You have that conversation with your investor, the uncomfortable conversation of a cash call. Like multifamily people, you see it all over Facebook, right? They all talk about the magic of cap rate, the magic of you get a big lift, right? For every dollar of income, you get $200 in value, and it's true,
Yeah.
right? If you get $100 increase on one unit, you just created 20 grand in value, right? You do that
Hmm.
across 20 units, that's $500,000 bucks. But what people
Yeah.
don't talk about is that also works in reverse. If rents go
Hmm.
down.
Hmm. Yeah. That would be kind of a tough situation, because obviously your goal as an investor is to add value to a property, but there are sometimes things that come into play that you don't really have control over, and that might lead to an unfortunate situation of a cash call.
Yeah, and like you mentioned, the Alberta markets, right? And that happened. That wasn't just me. That was every single investor in Alberta was affected by that. And like if you bought in 2014 at the peak of the market at 120 a door, you probably lost money. You probably had these uncomfortable conversations, regardless of
Hmm.
how cheap you bought your asset. So
Yeah.
how I get around that now is I have a very healthy reserve fund, about 7.5% of the purchase price. I extend the terms of my JVs from 5 years now to 10 years. And I basically
Hmm.
paint a worst case scenario of something that I know I'm going to be able to do, right? So it's very much under promise and over deliver.
Yeah.
In the early 2000s, stuff was going up like crazy. You see these banners everywhere, 15 to 20% ROI, right? Well, really, you don't really know that until you hit a capital event, until you either
Hmm.
refinance or you sell the asset, right? So
Yeah.
it's really tough to tell because a lot of that is intrinsic and built in.
Yeah.
But
And
I still think multifamily is the way to go, right? In the right
sure.
cases.
Yeah, this isn't to say that it's not a good thing to invest in.
Don't
Like
want to
for
scare
someone
people.
listening, it's just you got to be prepared, and it's not always sunshine and roses. So I think what you talked about there with the expectations, that's really important. You touched on doing longer JVs, so 10 years instead of 5. That's one thing that I learned, because I was in a coaching program with Quentin D'Souza a couple years ago,
Yeah.
and at that time the market was going crazy, so you could buy anything, like let's say a single family home, and then refinance it a few months later and not do anything to the property. But as part of his coaching, he'd always say, whatever conversation you have with your partner, make sure that they understand that this is a 5 year thing. This isn't, you're not gonna pull all the money out necessarily in 6 months. Expect 5 years. So I like what you're saying about in this market extending that, so that the expectations are clear from the start and you don't have any miscommunications with your partners.
Yeah, and you know what? I love the example that you just gave. Of doing very well, hitting a home run in 6 months. That's not the JV deal you want to paint to future investors. To
Hmm.
think that I can do this all the time, right? You want to talk about your average deal, or the one that you maybe made 10 or 20%, and then you can maybe
Yeah.
include that one and say, oh, okay, well we did okay on this one. But a
Hmm.
lot of people got it's easy to go to your head, right? Because you do well. Oh, look how easy this is. It's like I bought a
Yeah.
stock and it doubled, right? And then you
Yeah.
you get in
Yeah.
your psyche that it's just easy and you can do this all the time. I love that you mentioned Quentin. He's a veteran. He's been at this for a long time. He's
Hmm.
nailed down a very good niche strategy that works well in Ontario that wouldn't
Yeah.
wouldn't work so well on the prairie. So we've had a lot of discussions on that. But yeah, I mean, you have those bursts of, incredible appreciation,
Hmm.
but you have to think to yourself, if it can go up that fast, it can probably go down that fast. And we're seeing
Yeah.
that now.
Yeah, for sure. Um, so speaking of partners and expectations,
Yeah.
do you do all of your deals with joint ventures, or are you like, do you have any plans of going down the private equity fund route or anything like that?
Yeah, I talked to Christian Spilfogel, and I don't know if you know Christian. I talked to him a couple days ago, and he's completely self-capitalized. They have a family-run business. He's bought all of his multis, done his refinances, repositions with his own cash. And I've interviewed a few people like that, and ultimately that's where I would like to be. Um, I'm actually back to doing JVs, so I actually did 6 or 7 joint ventures. I raised all the money. The investors put in all the money. I operated the deal. We did a 60-40 split on the equity. Now, the last 2 deals I did, which was actually Raleigh, the one that you talked about, and Adams, I actually funded with my own cash with one partner, actually on Spruce Grove as well. So I ended up supplying my own equity. We ended up doing our burn, our refinance, getting the money back. So
Hmm.
I want to do more deals myself, but at the same time, I'm in a situation now where I'm looking around, basically like a kid in a candy store, where there's literally
Oh.
deals everywhere. And I did a I did a webinar a couple of weeks ago to raise capital for my latest deal. So it's an 18 suite apartment building just north of Edmonton. And I think we raised 3 times the amount of money we needed for this project on that call. So now I'm
Hmm.
scratching my head. It's like, okay, well, I have to go out and find more buildings. So I'm most likely going to maybe move to like an LP/GP model where I can
Yeah.
raise capital in a more efficient way, and then just go and buy multiple assets. But I kind of prefer to sit back and cherry pick deals, and I'm
Hmm.
very patient and strategic. And when one comes along, I'll sometimes negotiate a deal for 6 months or more if it's a good deal.
Yeah.
And
Yeah.
that's kind of how I've gone about it.
Well, that's the benefit of today's market, that you have the time to negotiate deals. Whereas a couple years ago, at least
Yes.
in Ontario, you couldn't even put conditional periods in at times on these multi-unit
That's
buildings.
crazy. I know, and I
Yeah.
heard about that, and like Quentin told me about that, and Dahlia Barson told me about that too, and it's just
Hmm.
like, wow, what? Crazy. And now
Yeah.
you can actually put in due diligence clauses. You can
Yeah.
actually do
Yeah.
your homework. You can put in financing clauses, and
Yeah.
and
Yeah.
sellers wouldn't accept that before. It's like, what?
I know, crazy. So you kind of touched on two things. Like at first, you were saying you like the idea of putting your own capital in and not really having joint venture partners, kind of being self funded. And then after you said you're considering going down the LP limited partnership structure. Which one? Why is it that? Which one do you prefer, and why is it that you would want to self fund your deals?
Yeah, so I started on that path of self-funding, but then I realized this was right around the same time that I started sort of doing these podcasts like with yourself. I started doing training, and then I realized there was a lot of demand for these type of investments, right? I mean,
Hmm.
people are looking at the stock market and realizing that maybe this isn't where I want to be. I want to be in a real estate investment. I want to be in a long-term stable one. And multifamily seems to be the way to go. So now I'm thinking to myself, well, now I need to service more people. It's always about helping more people, right? So whether it's coaching people on how to buy a multi, or investing in one of my deals. So that's why I want to do a mechanism where more people can get involved. And I probably won't self fund my deals anymore, simply for the fact that I think of it as like a switch, right? It's like almost like if you're a realtor. Let's say you're a realtor and you're selling multifamily, and let's say you have 5 clients, but you only give the best deals to yourself. You're buying them secretly, and you're not
Yeah.
really servicing your clients. So I'm thinking of it that way too. If I have the best deal and I'm just putting my money in, and I'm not allowing other people to participate, I'm not really doing them a service, right? So this
Yeah.
is why on the last deal in Fort Saskatchewan that we're doing, which is by far the strongest deal I've ever done, I decided to do the JV route. I could have self-capitalized that one, so I'm using this one as a stepping stone to go in that direction. And
Hmm.
honestly, I don't think I'll probably fund a deal myself again. Um, Maybe in a different asset class. I might do
Hmm.
maybe a bed and breakfast or a hardware store or something like that, right? But
Yeah.
if I find a really powerful multifamily asset, it's going to go into a pool where other people can benefit as well.
Got it. Got it. So another thing that I was thinking of was, how you said you were cherry picking and you were finding all these opportunities now in the way the market is. So what I'm seeing in Ontario is that prices have definitely come down, mostly because the rates have come up, and so that impacts the value of the building with the debt service ratio and all that. Um, However, so prices have come down, but the deals still don't make sense with a lower down payment. So at what point do you look at something and say, well, I mean, it's still a little bit overpriced, but the prices have come down quite a bit? Or do you just stick to the fundamentals and say, well, based on this spreadsheet, this deal doesn't make sense. I'm going to wait or try to negotiate the price down?
I mean, that's a great question. I love that question. And honestly, I mean, sellers always want last year's prices, right? I
Yeah.
mean, I want last year's prices. We all have a certain endowment effect when we buy a property. It's suddenly worth way more just because we own it. You
Yeah.
know, because now I bought
Yeah.
it for 100,000. Well, just because Cory has his name on it, now it's worth 150, which is,
Yeah.
really foolish thinking. But that's the way we think, as human beings and as investors.
Mm-hmm.
Um, but to your question, no, I'm not going to change my approach. The biggest change for me has been the loans have been scaled back because of debt coverage ratio, just like you said.
Mm-hmm.
And I get people calling me crazy all the time, realtors, other investors, and I get whipsawed very often. And what that means is I basically price what the property, for the realtor. They'll say, "What do you think this is worth?" And I know this so well just because I've analyzed thousands of properties, I've toured hundreds of doors. I know how much it's worth. And they'll say like, no way the seller's ever going to accept that. And sometimes, like three times, the building has come back to me. They've had several deals fall apart by other
Mm-hmm.
investors. Maybe they weren't qualified, they didn't get loan opinions first, they didn't know the rental markets, and they come back and say, okay, Cory, you're right, okay, I'm ready to sell. So three times I bought buildings that way.
Mm-hmm.
Most of the time it ends up selling to someone else for the price that I told them it was worth. And that's what
Yeah.
I mean by
Yeah.
whipsawed. So I very much stick to my guns. I mean, I know what I'm doing, but I'm fair. I mean, I don't try to lowball.
Mm-hmm.
There's definitely ways you go into negotiation. A lot of people go into negotiation guns a blazing. They insult the sellers, etc. I'm honest with people. I say, look, for what I'm trying to do, this is what works. But I am steered in a little bit more of taking on more risk now because of the
Yeah.
trajectory of Alberta's going. So I
Mm-hmm.
might consider paying more, a little bit more, because I know that
Yeah.
the upside is there. I can see it coming, especially because the wave has already hit Calgary and it's on its
Yeah.
way north, right? So I will take on a little bit more risk, but there's a point that I just won't go to. But
Sure.
yes, I will take on more risk today than I would a year ago for sure, and I'm much more
Yeah.
aggressive
Yeah.
now.
So I guess to get down to it, are you willing to overpay a little bit today based on certain factors?
Yeah, so overpay is kind of a relative statement, right? Like I think of it in terms of upside. So upside is
Mm-hmm.
my magic go-to formula. So let's say a building's 100 a door, but let's say like the rents are low. It's maybe a little bit beat up, but
Yeah.
I know when it's repositioned, it's going to be like 150
Yeah.
plus, right?
Yeah.
So yeah, I mean, I might pay 110 for that because I know that I only have to spend X to get to
Mm-hmm.
this. So based on the current market, I might be willing to pay more for that particular asset. But it,
Sure.
it very much depends on the deal, right?
That's definitely a benefit of investing where you do, because in Ontario you can't really look at it that way, because you're
Exactly.
not getting those tenants out that easily. They're going to put up a fight, or you're going to have to pay out a lot of money to get them out.
It's crazy, and I tell people in Ontario and BC, it's like, what kind of a business model do we have as multifamily investors where we have to kick out our customers to make money, right?
Yeah.
Like I look at a rent roll from Ottawa, like a 20 suiter, you'll have rents of like 695,
Yeah.
585, and then 1500, 1500,
Yeah.
2500. It's like, what the hell is this? Like you look in
Yeah.
Alberta,
Yeah.
it's like all the same, 1250, 1250, 1250,
Yeah.
because you can
Yeah.
go in there and just raise rents all at once.
Right.
And
Right.
that's probably why we have a healthy vacancy rate. I mean, I'm not
Sure.
saying if we got rid of vacancy rent control in Ontario, suddenly, the world would be rosy again, but it would certainly, incent a lot more people to get into being landlords and create more
Yeah.
units. There's no doubt
Well,
about
I
that.
guess it kind of sounds like the removal of rent control kind of creates a more of a median in rents rather than having a huge discrepancy like we do in Ontario, where, like you said, you have that $600 a month rent, but in that same building, you've got $1,700 a month for the exact same unit.
And I really ask what rent control actually does, because if you look at Ontario, like in Toronto, like you can see the stats, rents have risen like 40% in a year.
Hmm.
Well, that hardly sounds like rent control. Rents are 40% higher. Same thing in BC, but it didn't affect the person who was in that unit that they couldn't, kick out cash
Yeah.
for keys or whatever. But
Yeah.
the problem with rent control is once it comes in, you can't get rid of it. I mean,
Hmm.
rent control came into New York City because of the Second World War, when you had a bunch of people that were going to the port to go overseas to fight. So they put temporary rent control in there to control the prices for people who
Hmm.
were getting on the boats. And once it's there, you can't get rid of it.
Yeah.
And we see
Yeah.
that in Manitoba and Ontario, and now I believe New Brunswick even has it.
Yeah.
And to
I
go
think so.
backwards out of that is very difficult, because it's also a political hot potato. You know,
Yeah. For
politicians
sure.
love to use that. They love to butcher us. Greedy landlords for taking advantage, and it's a very
Yeah.
popular way to get elected, right?
Yeah. Yeah, well, you know
So
what? Rent control makes landlords in Ontario look like the villains. Like you kind of, if you're trying to run a business, you have to increase rents because you don't want to. You can't take on too much debt and then have the rates go up substantially and then get caught in these situations. So you have to find a way to raise rents. So
yeah.
either you evict the tenants or you have to pay them. And now you're looking like the greedy guy that's coming in there to jack up rents by $1,000 a month, and that's the tenant's perspective. They don't really see the landlord's perspective.
Yeah, and it's actually causing the problem because it's causing the scarcity. I mean, that's the reason why there's zero vacancy, why someone won't move, right? That's why you
Hmm.
have to do cash for keys. Like I'm sure a one bedroom wouldn't be worth 2,500 if you had 5 or 6% vacancy out there. It
Sure,
just wouldn't.
sure.
There would be enough competition, right? But that's
Yeah,
unfortunately the shortage that we're in right now.
yeah, yeah. Well, I generally like to ask this because, like, we can see your accomplishments. You've obviously been able to acquire a lot of real estate. What are you aiming to accomplish here? What are you? Is there like a specific target you're reaching for, or are you just growing as much as you can?
Yeah, I'm very cautious about growing too fast, and the only disadvantage, like I'll go back to cherry picking again. I like that because I know that I can give maximum value, maximum return to my investors, because I'm only going to choose deals that make sense to me. I'm not sitting on a pile of cash where I'm pressured to go out and buy something. So if I did an LPGP structure, I would raise like $10 million, but then all of a sudden the clock is ticking, right? I have to deliver a return to these people. I'm taking fees. I have to go out and find assets. That can benefit me in a lot of ways because I have a lot of power in negotiations. I can go and buy deals in cash. I can probably get better pricing, but then I'm under a lot more pressure.
Hmm.
So I'm kind of really at this crossroads of where I want to go with this. And most likely, what I'm going to end up doing is going to the larger buildings, 50, 80 to 100 units, which they are more rare in Canada, but those deals are there. And then just getting better pricing and raising capital for those deals. I'm
Yeah.
not discounting the LPGP route. It was a goal for last year going in. I know a lot of my colleagues. I don't know if you probably know Mark Baltazar. Um,
Yeah. Yeah.
they've gone that route, right? They've gone the REIT and LPGP route. They're big enough now, and they feel that's the next step for them. But I'm
Hmm.
very much kind of in a pattern of, I think I can deliver the most value on a deal by deal basis, right?
Sure. So speaking of Mark, so he's got a partner that he works with on his deals, and a lot of the people that I've spoken to that have LPGPs, again, that's limited partnership and general
Yeah.
partnership, um, they seem to have a partner involved that on the GP side. Is that something you plan on doing, or do you feel like you're more comfortable just doing managing things on your own?
Well, you're really hitting me with these great questions.
Yeah.
It's this is fantastic because, yeah, it's Mark Baltazar. It's what's his name? Rockwell, right? Can't remember his first name.
Rockle. Yeah, Rockle.
Yeah, so yeah, the two of them, they complement each other very well. I mean, I know them very well. I know Mark very well. He's a good friend of mine. I've
Hmm.
done stuff with him. We've had a lot of great chats. And yeah, there is definitely strength in numbers when you have two sophisticated investors going together. And I was always a one man show, right up until I bought Adams Apartments. But I've recently started to work with another gentleman, Michael Bug. He's a
Hmm.
he's a veterinarian out of Saskatoon. He
Okay.
doesn't quite have the experience that I have, but his honesty and integrity are the highest I've ever seen. And he just has such a great way of talking to people. And being in the veterinarian world, he has access to a lot of people that have a very high net worth that want to invest. Because
Okay.
what I find, and you've probably seen this as well, a lot of people that are, doctors, lawyers, very high net worth people, they love real estate. They're sophisticated. They just don't have the bloody time, to invest. So they would
Hmm.
rather find someone who they can trust and they know, and they invest with them. And
Yeah.
that's what we're basically doing on this next deal. So, you know, and also, Mike and I can talk about things. If I make a mistake, he picks it up. He makes a mistake, I pick it up. But it's important if you have a partner to have opposing skill sets, right?
Hmm.
You can't
Hmm.
both be good at property management and both be crappy at raising capital, right? You have
Right.
to you have to complement each other. So
Sure.
I've heard horror stories of partnerships breaking up, etc. But fingers crossed, this has worked out well for me so far, and I think going forward, we actually looked at doing an LP with actually a third party. We had a realtor in Saskatoon. We were looking at, building something very large. But
Hmm.
the more people you get in there, the more difficult it is. And if you go really large, like if you go REIT or Western Wealth Capital or something like that, right? You go into the States buying, tens of thousands of doors. You're essentially like, you're working 80 hours a week. Like
Yeah.
that is your life. And Mike and I are both like, well, we don't necessarily want that in our lives. I mean, we both have kids. We're both busy. I like taking my snowboard and going skiing some days, right? I mean, I want to have a life too. So there's a
Yeah.
real balance there, right?
Yeah. Yeah. For sure. Um, so we touched on a lot here. I appreciate you sharing
Yeah,
that. Do you feel like there's
that's probably
anything
too much.
we missed? Do you feel like there's anything we missed or anything important that you want to share?
Yeah, I just want to caution like new investors, not necessarily caution, but just be very wary of the gurus that you're following. And we mentioned Quentin and Mark, some very high integrity individuals.
Hmm.
But we're in an era of social media and Facebook where you see stuff everywhere, right? Make money, get
Yeah.
rich quick, way more than it ever was when I was starting. Like when I started, we only had RAIN, we had the Real Estate Investment Network.
Yeah.
So I'd say if you're getting multifamily for new people, follow someone you trust, follow someone
Hmm.
that has a lengthy track record of complete cycle, like purchase, reposition and selling,
Yeah.
through various market cycles, preferably 20 years or more. And just ask those guys, you don't go off someone who just became a real estate coach last year, to have some
Hmm.
kind of diploma. So really do your homework of the mentors you hire, and you do need a mentor. I mean, if you're going into multifamily, I could have saved myself a lot of pain and grief had I had that when I started. I
Yeah.
took the
For
very
sure.
rocky, tumultuous road, and it didn't have to be that way. But I would
Hmm.
say choose your mentors and people you associate with very carefully, right?
Yeah, sounds good. That's great advice because I do see that a lot as well on social media.
Yeah.
Everybody's giving advice, everybody's showing all the things they've done and accomplished and the properties they bought and all that. So it definitely makes sense to qualify, use your brain, figure out who you actually want to follow. So on that note, how do people reach you? And is there anything you're offering, any type of service or anything like that?
Yeah, so yeah, you can just reach me. The easiest way to reach me is altonequities.com, ALTYN
Hmm.
equities, and I'll give you the link after this, I guess. And
Yep.
then just
Yep.
just fire me an email. I mean, I'm also Facebook, Instagram. I do offer multifamily training, so it's called the 6 Pillars of Multifamily Mentorship, which is it's a
Hmm.
fairly inexpensive program, but it's very, very there's a lot of material in there. I got like, close to 50 modules in there, and it's a great way to get into multifamily if you're starting. So I have an alumni Facebook group, but I'm stepping back a little bit from coaching this year. I did it, pretty intensely last year. So I have
Hmm.
more of a self-study one-on-one type of style with my students now because I'm focusing, full-time on investing.
Yeah.
So yeah, just watch my website, altonequities.com, reach out to me on social media, search for the 6 Pillars of Multifamily. You can find me there. And yeah, I'm always contact me at any time. I love talking to other people.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.